Hey, this is Chris, and in this video I'm going to be answering a common client question, which is there more risk when investing in a recession? Now, over the long run, we know that the share market in Australia has returned something like 10 to 11% per year over the last 100 years or so, and that 10 or 11% per year includes good times for the economy and also bad times for the economy. And the reason why you get rewarded with such a great return when you invest in the share market is because you need to accept a level of ups and downs along the way. So there's periods where the markets go up for a little bit, down for a little bit, but they still even out and give you an amazing return of 10 or 11% per year. They definitely don't come in a straight line, and it's that risk that you're accepting that actually gives you the great return. So then there is a fair question, which is there more of a risk to investing when economic times are no good, when we're in a recession, when people are losing jobs and this sort of thing? And the answer, counterintuitively probably, is no. If you look at recessions in the past, and there's been some great studies that have been done on this, particularly in the US, where we've seen a few more recessions over the last 50 years than Australia, markets have actually gone up just as often as they've gone down during a recession. And the reason for this is pretty simple. By the time a recession hits, usually it's pretty well known and understood by everyone that the recession's coming. And so that bad news is already baked into share prices. Companies are already expecting their profits to fall. They're already positioning for this. They're already letting go of staff. And therefore, by the time a recession hits, often the bad news is all out of the way and it's only positive news that's to come. So markets based on how the future turns out compared to what expectations are, as opposed to just how the future turns out overall. And when expectations are already pretty poor about the future, there is actually a lot more opportunity for positive surprises. And this is why there's been as many positive market returns during recessions as there have been negative. Because when a recession hits, there's often been positive surprises that the recession wasn't as bad as hoped, or the recession wasn't as long as expected, and they're all factors that may actually lead share prices to go back up, even though the news may stay pretty bad for a while. So our advice to clients is, if you hear the recession word a lot in the news, or you even see that a recession started, it's not a good reason to stop investing, because that lack of optimism that's already out there in the news and you're reading about is what's helping you to invest at a good price and probably get in at a level where others are frightened, and will probably give you as good a return as any other time in the market cycle.